Assalamualaikum. We are from Group 16. For this group assignment, our group has choose Petronas Chemical Group Berhad. Our group consists of 5 group members, which is Nur Shafinah binti Salihuddin, Mailan Shah binti Al-Sham, Nuraina Nabiha binti Zulkifli, Nur Fizlatul Husna binti Nur Azizul, and Siti Hajar binti Zabidi. Petrochemical Group Berhad is one of Malaysian public listed company and a prominent producer in chemical industry. Their primary activities are manufacturing, marketing, and selling a variety of petrochemical products such as olefin, polymer, and other basic chemical. PCGB manage its capital structure to sustain optimal financial health. This writing aimed to analyze PCGB capital structure from 2020 to 2022. The analysis include the factor influencing changes in the capital structure. We also evaluate and compares the leverage and profitability ratio such as debt to equity ratio, earning per share or EPS, and return on equity or ROE from 2020 to 2022. We also examine the PCGB dividend policy and history from 2020 to 2022 to assess the impact of PCGB dividend decision on shareholder value. To achieve the aim, both quantitative and qualitative methods are used in the report. Based on the analysis, we find a consistent increase in the debt to equity ratio, suggesting a deliberate shift toward leveraging, while EPS demonstrates a positive trend indicating improved profitability. However, ROE witnessed fluctuation, prompting to further investigation into the efficiency of capital utilization. Petronas Chemical Group Berhad capital structure and dividend policy play significant roles in shaping its financial health and shareholder relationship. The analysis reveals key trends, strengths, and areas for improvement, providing a comprehensive understanding of company financial landscape.
Assalamualaikum and hi, my name is Mailan and I will explain about the capital structure of Petronas Chemicals Group Berhad, PCG. Capital structure is a critical aspect of a company's financial framework, which determines how it secures funds to support its operations, growth, and other strategic initiatives. It involves the composition and proportion of different funding sources such as debt and equity. In this video, we will dive into the capital structure of PCG and explore the factors influencing its structure and any recent changes observed. PCG's capital structure is primarily composed of 2 key components, which is equity capital and debt capital. Equity capital in the context of PCG represents ownership interest in the company. Investors who hold equity, including common shareholders, possess a claim on the residual assets of PCG after all debts and other obligations have been settled. On the other hand, PCG's debt capital is acquired through borrowing, allowing the company to raise funds for its operational needs and expansion. This borrowed capital must be repaid at a later date, usually with an added interest component. Debt capital comes in various forms such as loans and bonds, and it represents an obligation for PCG to fulfill its repayment commitments. Analyzing changes in PCG capital structure can provide insights into the company financial strategy and risk management. For example, an increase in debt may indicate a need for quick capital infusion or a shift in the company's risk tolerance. Meanwhile, a higher proportion of equity may signal a conservative approach with a focus on minimizing financial leverage and associated risks. Next, I will explain about the optimal capital structure. The main objective in determining a company's capital structure is to maximize stockholder wealth. Stockholder wealth is often assessed through financial metrics, with the earnings per share (EPS) ratio being a key indicator. EPS represents the portion of a company's profit allocated to each outstanding share of common stock. A positive change in EPS suggests that the restructuring activities are favorable, potentially resulting in improved profitability and returns for investors. The calculation of EPS will be explained further later in the video. Maintaining an optimal capital structure is important for ensuring that a company has adequate funds to fulfill its financial responsibilities and simultaneously enhance returns for stockholders. To comprehensively analyze PCG's capital structure, various measurement tools are employed. These tools include the debt ratio, equity ratio, debt to equity ratio, earnings per share, and return on equity ratio. Let's take a look at the graph on the slide that breaks down PCG's debt ratio throughout 2020, 2021, and 2022. In 2020, PCG had a debt ratio of 22%, showing a decent reliance on debt for capital. Fast forward to 2021, and we see a bump to 24%, indicating a bit more dependence on debt financing. In 2022, the debt ratio shot up to 28%, signaling a more substantial reliance on debt compared to the previous years. So what could be behind this shift? It might be due to various factors like ambitious expansion plans, significant capital projects, or maybe a change in PCG's overall financing strategy. The PCG Integrated Report for 2021 revealed that the company's liabilities or debt spiked by Rm 2.2 billion, marking a hefty 25.5% increase, reaching a total of Rm 11.1 billion. This gives us some context, suggesting that PCG's capital structure is changing.
Equity ratio reflects the extent to which PCG relies on its own funds rather than external debt to finance its operations. From the graph, year 2020 recorded an equity ratio of 78%. This suggests a high dependence on equity as compared to debt. For year 2021, the equity ratio decreased to 76%. This shows a moderate decline where the organization relies a little bit more on debt for capitalization. For year 2022, the equity ratio falls to 72%. This indicates a higher reliance on debt as capital compared to equity. Overall, PCG has shown a favorable equity ratio as all 3 years exceed 50%. Generally, a higher ratio is preferred in the organization since there is safety in repaying debt and other liabilities. Debt to equity ratio highlights how a company's capital structure is tilted either towards debt or equity financing. The DE ratio helps the organisation to determine if there is enough shareholder equity to pay off debts if the organisation were to face a decrease in profits. From the graph, year 2020 shows a DE ratio of 28%. It then increased to 31% in 2021. For year 2022, the DE ratio shows a significant rise to 40% as compared to previous years. The debt-to-equity ratio of PCG is considered good because generally the lower ratio is relatively better. It is implying that the organisation is in less debt and less risky for lenders and investors to give the loan and invest. This may be seen by investors as a sign of an organization's ability to control debt commitments and possibly withstand economic downturns. Throughout the 3 years, Petronas Chemicals Group Berhad (PCG) have chosen equity financing over debt financing. It is more economical because there are various financing and servicing costs when using debt. Ideally, companies should not heavily rely on too many debts to fund their operation in order to gain investors' trust.
A company's net profit divided by the total number of outstanding common shares is known as earnings per share or EPS. It shows how much money a firm produces for each share of its stocks. The earnings per share ratio of Petronas Chemicals Group Berhad shows that in the year 2021, the organisation performed better compared to the years 2020 and 2022. The earnings per share ratio in 2020 is 0.204 or 20.4%, increasing in the year 2021, which is 0.918 or 91.8%, and the ratio declining to 0.79 or 79%. The best earnings per share ratio is in the year 2021, and it is because of the organization earnings. The highest earnings per share shows that the organization performed well during the period and the investors are willing to pay more for the shares. Return on equity (ROE) is a percentage that is calculated by dividing a company's net income for the year by the total amount of equity held by its shareholders. The figure illustrates the firm's capacity to generate profits from equity investments and represent the overall return on equity capital. The return to equity ratio of Petronas Chemicals Group Berhad shows that in the year 2021, the organisation performed better compared to the years 2020 and 2022. The return to equity ratio in 2020 is 0.051 or 5.1%, increasing in the year 2021, which is 0.207 or 20.7%, and the ratio declining to 0.159 or 15.9%. The better return on equity ratio is in the year 2021, and it is because the organization is efficiently using its shareholders' equity to generate the profits. It is a positive sign to investors because the ratio shows that the Petronas Chemicals Group Berhad can generate a good return in investment.
The next content will be the assessment on dividend policy. PAT shows a net income available to shareholder. A higher PAT implies greater profits, and this means that PCG has the ability to provide more funds to allocate to dividends. PCG is struggling with the pandemic in 2020, but still able to obtain a good financial performance with a PAT of 1.6 billion ringgit and increased to 7.3 billion ringgit in 2021, but slightly decreased in 2022 with PAT of 6.3 billion ringgit. We can see that PAT has a positive correlation with dividend per share. In 2020, PCG has paid 12 cents of dividend per share and increased to 56 cents on 2021. Like PAT, it slightly decreased to 41 cents in 2022. Usually, shareholders expect a high dividend. From the graph above, the dividend in 2020 is the lowest value with 161.51% and increased to 627.80% in 2021 and recorded the highest dividend yield. In 2022, the dividend yield decreased to 474.74%. The inconsistent dividend yield trend occurs due to the inconsistent net income available to shareholders. A high dividend yield will attract more investors and indicates financial stability. Investors attracted to a higher dividend yield because it provides a stable income stream. From the graph above, PCG experienced a negative dividend growth in 2020 with negative 33.33%. but there has been a significant growth in the growth rate of PCG dividend rate in 2021, with 366.67%. In 2022, also experienced an increase in dividend growth rate, but only 26.79%. However, a negative dividend growth rate is not always a sign of financial distress. This may be a strategy taken to temporarily reduce dividends to redirect funds for strategic initiatives or to strengthen their financial position. Based on the graph above, all 3 years show a high dividend payout ratio. This indicates that PCG has a large share of income distributed as dividends. 2021 is the highest dividend paid ratio with 61%. 2022 is the lowest dividend paid ratio with 51.9%, and 2020 recorded 59% of dividend paid ratio. This ratio helps to understand the company's earnings that will be returned as dividends. The last graph tells us that PCG has a ratio greater than 1 from 2020 to 2022. This means PCG earnings are more than enough to cover its dividend payments.
PCGB maintain a robust capital structure aimed to sustain an optimal financing for its operation and maximize their shareholder value. Their debt-to-equity ratio, which is a crucial leverage indicator, has increased from 0.28 in 2020 to 0.40 in 2022. Even though it's still within the acceptable limit, the rising ratio suggests a shift toward high leverage. PCGB preference for equity financing over debt align with their conservative capital structure, minimize risk associated with excessive debt. However, their earnings per share experienced a decline from 2021 to 2022, attributed to increased operating expenses and the integration of the acquired subsidiary, which impacted the operating expenses, and the integration of the acquired subsidiary, which impacted the profitability. However, their return on equity, which is a key indicator of the efficiency in utilizing shareholder equity, peaked in 2021, indicating optimal use of equity for generating profit. The subsequent decline in 2022 could be attributed to increased operating expenditure and the integration of the acquired subsidiary. PCGB dividend policy reflects its commitment to shareholders with dividends which are influenced by profit after tax. Despite their economic challenge, the company demonstrates resilience by achieving excellent PAT figures, which is positively impacted the dividend distribution. The recommendation is PCGB may consider to focus on their cost management and efficiency as it could further enhance profitability, which is positively will impact the key financial ratio. That's all from us. Thank you.